Hi UBS. So what are your key takeaways from big tech earnings?
Overall, it's been a strong earnings season. Hyperscalers cloud growth accelerated again, moving from 34% year-on-year to 40%, and we think second quarter likely brings another leg up. But backlog really stole the show. The big four hyperscalers booked close to $2 trillion in contracts, nearly triple what we saw a year ago. As a result, the tech-heavy Nasdaq Composite Index is now tracking 47% year-on-year earnings growth for the quarter. A big jump from just 23% growth that consensus was expecting at the start of the year. And it's not just a handful of names doing the heavy lifting. About 72% of companies have beaten expectations, with broad-based positive earning revision, reinforcing the underlying strength across the sector. Looking further out, full year 2026 earnings for the index are now expected to grow 37%, up from an already punchy 26% at the beginning of this year. Expectations for 2027 have also moved meaningfully higher, to around 19% growth versus just 9% previously. We still see upside risk here, given the sustained momentum in capex across large tech platforms and the spillover effects into the semis and hardware, which make up a sizable share of the index.
So how has earnings guidance shifted your capex outlook and positioning for big tech?
With AI monetization improving and backlog building, hyperscalers have raised capex budgets again. As it stands, we are looking at roughly $820 billion of AI-related capex this year, which is close to 70% growth versus last year. And it doesn't stop there. In 2027, spending could push towards $990 billion. The big four will likely account for more than 85% of that spend. But there's a flip side. As capex keeps rising and free cash flow gets squeezed, balance sheet expansion through incremental debt issuance is starting to matter more. Over time, that could bring back investor concerns around overbuilt risks. And that's why we continue to advise investors to avoid over-concentration on their Max 7 exposure. Too much concentration can become a drag, especially as headwinds build. We are talking about rising competition in advertising from AI-native players, equity flow pressure from mega IPOs, and a gradual deterioration in balance sheet and ROE profiles. Within the Max 7, we still prefer the companies with strong chip design capabilities and select hyperscalers with accelerating cloud growth trajectories.
Thanks Delwin, see you and AR in the future.